Hi there, this is CMA Nishanth Reghunath welcoming you to a new video under my study for income tax. In this video, we'll be learning about a very important concept under capital gains. And that concept is exemption or deductions under section 54 to 54H. Now, we know the term exemptions and deductions mean two different things. And the reason I've used exemptions or deductions as a description here is because in certain materials you'll find it to be mentioned as deductions. For example, in the material issued by the ICAI instead of Cost Accountants of India, you'll find that it is referred to as deductions. Whereas in various other materials you'll find it to be mentioned as exemptions. Alright, so in this particular video, when I mention exemption or deduction, I'm referring to the one and same thing. Alright, so generally all these exemptions range from section 54 to 54 GB. H is actually not an exemption or a deduction, but then H is a section wherein a very important clause with respect to these sections are mentioned. Hence, I have categorized or clubbed it along with the study. Alright. So before we head into the detailed learning of all these sections, let me give you a briefing regarding the whole structure of this chapter, structure of this area. So we know that in order to have an income taxable under capital gain, we should have a capital asset which is to be transferred, and in that transfer a capital gain or loss will arise, right? So we know the way to compute, the formula for computation of capital gain is we first take the full value of consideration, right? From that we deduct any expenses on transfer if applicable, right? So we deduct this, and what do we get after that? We get the net sale consideration. Please do bear in mind these are not official short forms. I'm just using them for the ease of teaching. So net sale consideration is what we get after this. And from net sale consideration, what do we deduct? We deduct the cost of acquisition or indexed cost of acquisition, and we deduct cost of improvement or indexed cost of improvement, right? We deduct these two items. Finally, we get our capital gain or capital loss, right? Sorry, capital gain or capital loss. Now we had learned in the section about chargeability under section 45, we learned that it's not only necessary that we get a capital gain here, we need to check whether our capital gain, if it's capital gain here, we need to check if it is not exempted under sections 54 to 54 GB. So if we have any exemptions or deductions under sections 54 to 54 GB, we take that out as well. And finally we get taxable capital gain, right? So we know this is the basic format by which we compute capital gain, yeah? So there is a capital asset, it is transferred, and based on the transfer we do this whole computation, yeah? We do this whole computation based on the transfer, yeah? And arising out of the transfer we check whether we have a capital gain or loss. Now what Income Tax Act says is, say we have capital gain. In order to see whether we are eligible for sections 54 to 54 GB, what we need to do is, we need to check what we have done with the capital gains that we have received out of this transfer. We need to see what have we done, what has the SC done with respect to this capital gain. Now the SC has an option. SC has an option to make an investment with whatever capital gain the SSC receives. Alright, so the investment option that is available to the SSC is in form of two parts. One is, out of the capital gain he or she receives, or the SSC receives, he or she or the SSC can acquire a new capital asset. Now this capital asset shall be a new replacement asset. Say the asset we are talking about is a house property. The capital asset is a house property. Transfers it, gets capital gain, and out of the capital gain that he gets, that the SC gets, the SC decides to make an investment in a new house property. So new replacement asset. So replacing the old asset is one form of investment. Another form of investment is in some specified assets. some specified assets, specified bonds, specified certain kinds of funds as categorized by the government. ICAI can make an investment in some specified assets. Now, this falls under sections EC and EE, 54 EC and 54 EE. So just keep that in note. Or the ICAI can choose to invest in a classified or a specified company. Specified company. Generally a startup or a small or medium enterprise. Alright, this falls under section 54 GB. Yeah. So an ICAI can make an investment in a new capital asset, which can either be a replacement asset or a specified asset or a specified company. We learn about what these specified assets are and what a specified company is in their respective sections. Or the ICAI can choose to make this investment in a specific deposit scheme and an account scheme known as capital gain deposit scheme. That is a scheme provided by the Income Tax Act to the ICAI such that if the ICAI does not find a new capital asset wherein he can invest and he doesn't want to pay any tax for the capital gain that he receives out of this whole sale transaction, then the ICAI can invest or put that money in a deposit scheme, capital gain deposit scheme. So the investment can be by way of getting a new capital asset or putting it in a deposit scheme or doing them both. So ICAI can actually say out of the sale of this house property, ICAI gets say 1.5 crores as capital gain. Alright, ICAI puts 1 crore in new HP. Alright, ICAI puts say 0.2 crores, that is 20 lakhs in some specified assets. And the balance of 0.3 crore ICAI puts in the capital gain deposit account scheme. Alright. So I'll be referring to this capital gain deposit scheme as CGDS or CGAS in my study. I've just shortened it for the ease of teaching. Yeah. So CGDS or CGAS, capital gain account scheme. So this is the whole structure. Now if the ICAI makes an investment as mentioned here, whatever investment he makes, he or she or the party makes, based on that investment. So based on this investment, ICAI can get an exemption under sections 54 to 54 GB. So the exemption available will be one based on the investment made, to the actual capital gain. So exemption will be minimum of the following. I forgot to mention that. Minimum of the following. First one, based on the investment made. At times it will be the actual investment made, and at times it will be a proportion of that investment made, and capital gain whichever is lesser. Alright. Say ICAI gets a capital gain of 1.5 crores. Say let's take for example ICAI only invests 1.4 crores. So 20 lakhs in specified assets, 20 lakhs in CGDs, and 1 crore for new house. ICAI has only invested 1.4 crores. So based on investment, the actual amount is 1.4 crores and the actual capital gain is 1.5 crores. So ICAI will get the minimum of the following as exemption, and that is 1.4 crores. So that is the structure for this whole study. Alright. And in this study, this area, that is a capital gain deposit scheme, is a very, very important area, and you guys need to be crystal clear about its concept. So before heading into this study of all these sections, I'll be explaining what capital deposit account scheme is as per our institute's guidelines. Alright. So first we'll go to the institute material and see what a capital gain deposit scheme is, and post that I'll give you certain notes. Also please do note, this study is going to be a bit too long. This might be a bit too long, and you might want to increase the speed of this video in case you are already familiar with this topic, if you are just looking for revision, or in case you find it a bit too much of dragging. Alright, if you find it a bit too draggy, you can increase the speed. Just increase the playback speed to whatever would be suitable for you. So yes, that is the structure. Now let's learn what capital gain deposit scheme is. Before going to capital gain deposit scheme, let me give you a brief introduction. Before going to the institute's material, let me give a brief introduction as to what this capital gain deposit scheme is. So let me just rub this all out that you see on screen here. So in short, the capital gain deposit scheme is nothing but an account an account which is to be started with a nationalized bank. Nationalized bank as per the provisions of Income Tax Act to deposit whatever capital gain we receive out of a transaction. Okay, so what Income Tax Act says is, in case you do not find a new asset or a new capital asset wherein you can put your money in, you may choose to deposit in a nationalized bank by opening a capital gain deposit scheme such that you will get exemption. So for example, the SSC sells their house property, gets capital gain, but then does not find a new capital asset wherein the SSC can put the money received in. So Income Tax Act says, don't worry, I know you want exemption for the capital gain that you received. You have one choice. You can put it in a capital gain deposit scheme that you open with a nationalized bank. Alright, but in the Income Tax Act is very, very stringent here. What they say is, you have a utilization period here. Now you cannot put this money in this scheme and stay there for good. Now we will tell a period based on whichever section is applicable from 54 to 54 GB. We will give you a period within which you should actually use this money to get a new capital asset or to make a new investment. So say, as he sells house property, puts in a capital gain deposit scheme, Income Tax Act says you can keep it there for 3 years. You can keep it there for 3 years. Within 3 years, you have to find a new capital asset wherein you are going to invest. Alright. Now if you do not utilize it within 3 years, what happens is you will have revocation. You will have revocation. By revocation, what I mean is whatever exemption that you took previously, based on that, you will have a revocation to that exemption. That is, you will have a taxability attraction. Taxability attraction. Say I deposit 10 lakhs here. 10 lakhs here. I do not utilize within 3 years. I get exemption for this whole 10 lakhs. And at the end of 3 years, I haven't utilized anything from this 10 lakhs. I haven't utilized anything. So this whole 10 lakhs, if I had taken exemption, will become a revocation, and in the year wherein I violate the utilization period, for example, let this be in the previous year of 2021. So 2021, 21-22, 22-23 and 23-24. So at the end of 23-24, I violate. I do not use that 10 lakhs. So in that previous year, 10 lakhs will be taxable. Clear? Say I utilized 7 lakhs. I utilized 7 lakhs and the balance remaining is just 3 lakhs. That will be just 3 lakhs that will be taxable. There will be scenarios wherein it won't be the exact amounts that will be the deduction amount or the taxable amount. Say I make a deposit of 10 lakhs but I do not get complete deduction of 10 lakhs. I will only be getting a certain percentage or certain portion of it. In those cases, taxability will also be based on such percentage or proportions. So I deposit 10 lakhs but I only get a portion of 10 lakhs as exemption. So at the end of 3 years, I have 3 lakhs, but only a portion of 3 lakhs will be my taxable revocation. Alright, and that portion, the point that I stressed there, certain cases where only a portion will be given, not the complete amount will be given as deduction, and only a portion will be taken as taxable at the time of unfulfillment of the utilization period. That's with respect to sections 54, F and GB. No need to note this down. You will see further notes coming in and you will be able to figure out that 54F and 54GB have some special scenarios or special methods by which you actually find out the exemption available and you find out the taxable amount applicable to the SC upon non-fulfillment of the utilization clause. So clear? Yeah. So that's it for the structure. Now what I would suggest you is, I do not think I have to open the institute's material now. I'm hoping it's pretty damn clear, the whole CGDS thing. So now what I would suggest you is, get your study material right next to you. As and when I finish each section, we go from 54 to 54H, right? As and when I finish each section, pause the video, read what's mentioned in your study material. Alright, so let's head to our notes of each of those sections. So here it is. I've listed all the sections under this broad heading, exemptions from capital gain, and also I told you, you will find it to be mentioned as exemptions and deductions based on where you're reading this. So for this study, I'm using the term exemptions throughout, or at times you might find the term deductions, alright. So yeah, so exemptions from capital gain ranging from 54 to 54H, and A brief description of all those sections have been mentioned right below them. So pause the video, draw this chart out. Right, so we have total 10 sections, I think. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah. So exemptions end at 54 GB, but then 54H is actually a section which is directly applicable to sections of 54 to 54 GB. Hence, I've included it here. So pause the video, take this chart down. Right. Let's head to section 54 first. Section 54 is with respect to an exemption available to an assessee from capital gain on transfer of a residential house property. So all of the sections will be in this format, in a particular format, wherein I first mention to which assessee or to which all assessees the section is applicable to. Then I'll give you a basic overview of the whole section, right? So the first section, 54, exemptions from capital gain on transfer of residential house property, is only available to individuals or HUF. Now, a basic overview of the section is, assessee transfers a long-term residential house property. And by residential house property, what do we mean? The income of such house property was taxable under the head income from house property, under head 2, right, under the second head of income. And out of that transfer, assessee gets a capital gain and invests the capital gain from such transfer in following manner. Either acquire a new residential house property or deposit in a scheme. So assessee can either use that capital gain to get a new house property, one new residential house property, or use it to deposit in the capital gain deposit account scheme. Fine. Clear? Alright, basic, that's it. Now, if the assessee is acquiring a new property, he has two options, either to purchase a new house property or to construct a new house property. Say for example, the original house property, the house property that the assessee actually sells or transfers, the long-term residential house property, assessee sells it on 5th June 2020. 5th June 2020, assessee actually sells or transfers the old property. Fine. Now, if the assessee is planning to construct a new property, the time frame, the Income Tax Act gives a time frame within which you should actually finish constructing this house property. The time frame that the Income Tax Act gives is 3 years from the end of the date of transfer. So 3 years from 2020, 5/6/2020 would be 5/6/2023. So within 5th June 2023, you should finish construction. Alright, within 5th June 2023, you should finish construction. Now, if the assessee actually plans to purchase, instead of construction, assessee plans to purchase, then the assessee gets a very unique time frame. The assessee can purchase this new house property within a time frame which falls within 1 year before the date of transfer, within 1 year before the date of transfer, that is 5/6/2019, and within, or that time frame goes up to within 2 years after the date of transfer. Understood? If not, I'll explain. Say in this particular example, I said the assessee sells or transfers this particular property on 5/6/2020, right? So this is the point in time in which the transfer takes place. Now, if the assessee actually wants to construct a new house property, the time frame the assessee has is from 5/6/2020 all the way to 5/6/2023. So assessee has this much time frame to construct a new property. Fine. But in case assessee wants to purchase, then the time frame assessee has is from 5/6/29 to 5/6/2020. So 3 years here, 3 years here. To purchase, it starts from 1 year before the date of transfer and goes up to 2 years after date of transfer. For construction, it goes from the date of transfer up to 3 years after the date of transfer. Clear? Yeah? Pretty simple, right? So the assessee decides to purchase, it should fall in a time frame 1 year before X to 2 years after X. So within that period. X here refers to the date of transfer. If it's construction, from X, 3 years, within 3 years after X. Construction may start at any time but should be completed within this particular 3 years. Alright, now this asset, assessee has to keep it locked in for a minimum of 3 years. That is, for 3 years, assessee shouldn't transfer this asset. In case a transfer happens, whatever exemption the assessee claims will become taxable as on the date of transfer. Alright. Now, if not getting a new house property, assessee can deposit the whole amount in the CGDS. Now, I told you the Income Tax Act is very stringent here and will give you a utilization period. So, assessee will be given a utilization period of maximum 3 years from the date of transfer. Yeah. If not utilized, then whatever unutilized amount remains in the deposit scheme will turn to be taxable as on the date of violation of the utilization clause. Right. Now, Finance Act brought a very, very unique amendment, or not an amendment, an addition to this particular section. What they said was, there is a scenario wherein not just one assessee can purchase 1 + 1, 2 houses out of the capital gain the assessee receives out of the sale or transfer of a long-term residential house property. And when will it be applicable? It will be applicable in a case where assessee transfers house property, HP transferred, and the assessee gets a capital gain less than or not exceeding 2 crore, less than or equal to 2 crores. Say assessee sells a house property, gets a capital gain of 1.9 crore. What can assessee do here is, assessee can buy 2 houses and claim deduction or exemption under section 554. So 1 crore in one house, house A, and 80 lakhs in another house, house B. Assessee can claim deduction for both these houses. But say assessee says, I'm not putting 80 lakhs here, I'm putting only 40 lakhs here, and here I'm not putting 1 crore, I'm putting 50 lakhs here. I have remaining amount available of 1 crore here, I'm putting it in another house, 60 lakhs, and putting it as C. Alright, in this case, assessee will not get exemption. What Income Tax Act says is, the maximum houses that you may purchase in order to get exemption is 2, provided your capital gain stays below 2 crores, stays equal or below 2 crores. Alright, understood? Yeah? So if capital gain does not exceed 2 crores, it can be 2 houses, and it goes without saying the houses has to be in India, because it is not to the interest of the Indian government or Indian Finance Ministry if the assessee purchases house anywhere else, right? See, if assessee purchases a house outside India, it is not to the interest of the Indian Finance Ministry. So the government or the Finance Ministry or the Income Tax Act will definitely not give any exemption for a house the assessee purchases outside India. So it goes without saying. So if all the above conditions are satisfied, assessee can get an exemption based on the investment made, that is getting a new asset, or the deposit that the assessee makes, or the actual capital gain. Say, I'm taking this out, 50 lakhs, 40 lakhs. So the investment made is 90 lakhs. Capital gain is 1.9 crore. Assessee can get an exemption of 90 lakhs. Clear? Yeah? Whatever that is laying unutilized, here, what is the amount laying unutilized here? 1 crore is laying unutilized here, right? As of now, assessee can put it in CGDAS. So here, then it will be 1.9 crore. Both will be the same. Assessee can claim exemption for the whole amount. Yeah? So whatever the amount the assessee invests compared to the actual capital gain, whichever is lesser, will be the available exemption. Now, 2 points that I want to lay stress with respect to this section is this particular point number 2, which I've mentioned here, is very, very important. This exemption under section 54 shall only be available to an assessee for once in their lifetime. If the assessee claims exemption or deduction under section 54 for once, then he's done for it. He will not be getting exemption under 54 anymore. Alright. So this is only available for once in the lifetime of the assessee. And again, another point, any unutilized amount in the hands of the legal heir is not to be taxable. Say Mr. A sells his residential house property and puts the amount in the capital gain deposit scheme. It is to be utilized within 3 years. At the end of the first year, he dies, he passes away, and this capital gain deposit scheme goes to Master A or son, Mr. X, who's son of Mr. A. So within 3 years, this amount is to be utilized, right? Yeah. So in case after 3 years, Mr. X doesn't utilize, the son doesn't utilize, Mr. X, the son, will not have to pay any tax for that unutilized amount. because it was not Mr. X who made the deposit. It was Mr. X's dad, Mr. A, who made the deposit, right? Yeah. So any unutilized amount in the hands of a legal heir will not be taxable. All right. That's it. So pause the video right now, open your study materials and read what's mentioned there. All right. Now once that's done, let's go to section 54B. 54B relates to an exemption with respect to transferring an agricultural land, not just any agricultural land, urban agricultural land. So this section will be applicable to individuals and HUF only, not corporate assessees, not artificial persons. So let's check an overview of this section. Assessee transfers an urban agricultural land, and this particular agricultural land has been used by the assessee for agricultural purpose for at least 2 years, before transferring it. Alright, so assessee has an urban agricultural land, but the assessee has been using this agricultural land for at least 2 years in order to get exemption under section 54B. Say assessee buys a land on 5/6/2018. Alright, assessee decides to transfer this asset on 12/6/2020. So there is a period of 2 years plus happening. If the assessee actually use this particular land for 2+ years for agro purposes, then he can claim exemption under section 54B. But then during the time of usage, yes, he only used, out of this 2 years, only used 1 year for agro purpose, then no exemption. As he has to prove that the land has been used for at least 2 years for agriculture purpose, either by himself or herself, or by parents, or by the HUF. So by self, or parents, or by HUF. Alright, at least 2 years by the assessee in their own hands. If that's the case, any capital gain that the assessee gets out of the transfer of that urban agricultural land will be exempted, provided assessee makes an investment by purchasing a new agro land which can be either rural or urban. Do you know why here was specifically mentioned urban agricultural land? Say imagine if this had been rural, what would happen? If it had been a rural agro land, there will be no capital gain transaction because rural agricultural lands are out of the purview of the term capital asset. So if it had been rural agricultural land transfer, why do we need exemption? Because there is no taxability in the first place. It is an exempted income. Only if agricultural lands are urban, the transfer will attract capital gain, and only when capital gain is attracted, exemption is attracted. When there is no capital gain in the first place, then why do we need exemption? So that's why rural agricultural lands are not being mentioned here. Only urban, the transfer of only urban agricultural lands are mentioned here. But the new land that the assessee gets can be rural or urban, just that it needs to be an agro land. And it should be purchased within 2 years after the date of transfer. So transfer date happening on 12/6/2020, it should be purchased within 12/6/2022. Alright, within this particular date. Yeah? Right. If that happens, assessee can claim an exemption for that investment the assessee makes. Or if the assessee does not purchase a new agricultural land, he can choose to deposit in the capital gain deposit scheme, but then has a utilization clause of 2 years. Alright, has a utilization clause of 2 years. Within 2 years, he or she or the HUF will have to get a new agro land. Right? Fine. And that agro land has a similar lock-in period, just like how we saw in 54, 3 years. Right. That's it. If all that is satisfied, assessee will get an exemption of the investment in new asset plus the deposit, whatever he invests, or the amount of capital gain, whichever is lower. Alright. Now one very important thing that I want to tell you here is, in case this urban agro land was compulsory acquired, you know what a compulsory acquisition is, right? When the law comes to action and takes over our asset, we have no other mode of escaping it other than giving that asset to the government. So that's called compulsory acquisition. The government or the law enforced compulsorily acquires our property. If that's the case, the government will definitely give us a consideration to set off that deal. Yeah. Any consideration that we receive out of such transaction is exempted from income tax. Alright, So that's all for section 54B. I hope you got a really good understanding. Pause the video, read what's mentioned in your book. Now, hope that's done. Let's go to section 54D. Very, very unique section. Exemption from capital gain on compulsory acquisition of land and building forming part of an industrial undertaking. So this is a case of compulsory acquisition of an industrial undertaking. Alright. Now generally, it's with this section, section 54D, we get a clubbing of section 54H. 54H can be directly related to this particular section 54D. 54H is only applicable in case of compulsory acquisitions. Now it's not that compulsory acquisition cases are only applicable for 54D. Compulsory acquisition can come in any of those sections, 54B to 54GB. Anywhere compulsory acquisition can come, but generally, most of the times, compulsory acquisition cases are discussed under 54D, that is compulsory acquisition of an industrial undertaking. And that's the reason why I said I'll explain 54H with 54D. But then do not mistake, compulsory acquisitions are only applicable for section 54, it's applicable for all the sections. Alright. So yes. This particular section is with respect to industrial undertakings, right? So apply your common sense. Who all can own an industrial undertaking? Individuals can own, HEFs can own, but majorly it's corporates who own industrial undertakings, right? So this particular section is applicable to all SSEs because corporates have to be included as well. Artificial persons have to be included as well. Now an overview of this section is similar to what we saw under section 54B. What it says here is SSE has an industrial undertaking used at least for industrial purposes for 2 years. Just like in 54B we saw that agricultural land should be used for agriculture purpose for at least 2 years. This industrial undertaking should be used for industrial purposes at least for 2 years before transferring. A compulsory acquisition takes place of this industrial undertaking wherein the land of the SSE, the building of the SSE, or both, or any right, say it's a mining site and the SSE has mining rights over that site, the mining rights are taken over by the government. So that's a case where an industrial undertaking which is a mining site and the right of the SSE which the SSE had for mining was taken over, compulsory acquired. So in case a compulsory acquisition, as I mentioned, takes place, the SSE gets a compensation for that compulsory acquisition, and this compensation will be treated as capital gains. This capital gains will be exempt provided SSE acquires a new asset, that is acquires a new industrial undertaking within 3 years from the date of transfer, or SSE deposits this amount on a capital gain deposit account scheme. Clear? And it has a utilization clause of 3 years. So within 3 years the SSE will have to acquire a new asset, and this new asset which the SSE acquires should stay with the SSE for minimum of 3 years. It has a lock-in period of 3 years. So if all that is satisfied, the exemption that is available to the SSE will be whatever investment that the SSE makes. So investment shall be with a new asset or the deposit. So whatever investment the SSE makes or capital gain, whichever is lower. Alright, say the SSE gets, out of compulsory acquisition, SSE gets, say 5 crores. SSE gets 5 crores. That's a sale consideration. Capital gain is 2 crores. 2 crores is a capital gain. So SSE gets 5 crores, right? So SSE invests 4 crores in new undertaking. SSE invests 4 crores. That's it. That's all that SSE invests. So 4 crores falls in point 1. Amount of capital gain is 2 crores. Your exemption will be 2 crores. As simple as that. That's all for this section 54D. Pause the video, go read. Now coming to 54EC and 54EE. Now what I want you to know here is these sections are not standalone sections. They can be coupled with any of the sections from 54 to 54GB, and by that what I mean is, I told you right, when I told you about the structure of this whole study, we said investment can be made by the SSE in 2 modes, either get a new asset or deposit in the capital gain deposit scheme. It can happen as both, right? The asset can be a new replacement asset. It can be a new specified asset, or it can be a specified company. I told you, right? Yeah? It's this specified asset that's being discussed under section 54EC and 54EE. A case where SSE gets capital gain and invests in a specified asset. So let's take for example, SSE has a long-term RHP, LTRHP. So long-term RHP transferred, gets a capital gain of say 1.95 crores. SSE buys new RHP, A RHP for 1 crore, B RHP for say 50 lakhs. Alright. Invests in CGDS 20 lakhs. So 1 crore, 50 lakhs, 20 lakhs, now 1.7 crore has been invested. He still has a balance of, he or she or who the SCS still has a balance of 25 lakhs, right? He can take this 25 lakhs and buy specified assets as per EC and EE and get exemption for this whole 1.95. That's why I said these two sections are not standalone sections. 54 EC can be clubbed with any other section. 54 EE can be clubbed with any other section. So here what did we do? We clubbed 54 with 54 EC. That's what we did. We clubbed. So we took exemption under 54 and 54 EC. Under 54 we got exemption for the replacement asset and deposit scheme. 54 EC came into play when we took exemption for the specified assets. Alright. By specified assets, what I mean are the following assets. They are special bonds, which are 5-year redeemable bonds issued after 1/4/2018 by Rural Electrification Corporation Limited, NHAI, that's the Highway Authority of India, Power Finance Corporation, or the Indian Railway Finance Corporation. Also, any other bonds as specified in a notification passed by the central government. So generally in your questions, you'll only find the bonds mentioned from points 1 to 4. Rural Electrification, NHAI, Power Finance, and Indian Railway. So if the SSE gets any capital gain, gets a new asset, puts something in the deposit scheme, and decides to put something in any of these bonds, you can get exemption for these bonds as well. But while taking exemption for these bonds, exemption for the bonds shall be taken separately with sections 54 EC or EE as applicable. So getting a new asset and investing on the deposit scheme will fall in their respective sections, whereas getting the new bonds, getting the new specified assets will fall under sections 54 EC and EE. So both these sections are very, very similar to each other. The only difference is in the original asset. So let's check 54 EC and EE together. Alright. So applicable to all SECs? Applicable to all SECs. Overview. SSE transfers any long-term capital asset being land or building or both. So here it should be a long-term capital asset, which is a land, building, or both. Here it can be any long-term capital asset. That's the difference. Now, out of the capital gain that the SSE gets, the SSE decides to acquire some long-term specified assets. Same thing here. Acquires long-term specified assets. Date of acquiring within 6 months after transfer. Date of acquiring within 6 months after transfer. Alright. So this transfer date is the date of transfer, date of compulsory acquisition, compensation of compulsory acquisition, or date in which the converted capital asset is sold. Yeah, it's just now that I remembered, I didn't tell you what 54H is, right? So I'll explain 54H after EC and EE. Yeah. So X stands for the date of transfer, compensation of compulsory acquisition, or the date on which the converted capital asset is sold. You know that conversion of a capital asset into stock in trade is a capital transfer, right? It's a transfer as per Income Tax Act and will be subject to capital gains, converting a capital asset into stock in trade. So that conversion date will attract capital gains, but then taxability will only come as and when the converted asset is sold. We had discussed this in our study for special case of transfer, right? Yeah, special case of cost of acquisition, right? Yeah. Now, so SSE transfers their original asset, acquires a new specified asset within 6 months, and keeps it locked in for 5 years. Whereas EE says you only have to lock it in for 3 years. Lock it in for 3 years. So SSE gets these assets, SSE gets these bonds, and stays with the SSE for at least 5 years. Now, in case the SSE decides to pledge these assets and take a loan, it shall be deemed as a transfer. If the SSE takes the asset with them and pledges it for a loan, puts it as a collateral and gets a loan, it will be deemed as a transfer, and if it happens within 5 years, it will be treated as a violation of the clause. Alright. So if no violation takes place, SSE invests everything accordingly, gets a specified asset, and everything is clear, everything is clean, then the SSE can get a deduction or exemption. I have mentioned deduction here, so please do understand, it's because at certain materials, in certain materials, you will see it as mentioned as deduction. For example, if you take your study material, institute study material, if you take the institute study material, you will see it to be mentioned as deductions, but in certain other materials, you will find it to be mentioned as exemptions. So exemption shall be the minimum of following: the actual investment made, that is whatever investment that you make on those special bonds, limited to 50 lakhs, or the amount of capital gain. Check 54EE, it's the same thing. So this limited to 50 lakhs, I'll explain with an example. Say SSE gets a capital gain out of the transfer of 75 lakhs. SSE invests the complete 75 lakhs in bonds. Alright, so the investment made by the SSE is 75 lakhs. The capital gain, I'll put a different amount for capital gain. Capital gain is 1 crore. Alright, the investment made is 75 lakhs. So what we need to do first is take the investment that we make, check whether it crosses 50 lakhs. You see, you can cross 50 lakhs, you can invest whatever amount that you want, that's fine. But the deduction available or the exemption available shall be limited to 50 lakhs on the basis of 75 lakhs first. So at the first point itself, 75 lakhs get crossed out and it's 50 lakhs, that's a maximum available. Then take whatever capital gain that we have. We have a capital gain of 1 crore. So whichever is lesser will be our exemption. So our capital gain exemption will be 50 lakhs. Clear? Clear? Fine. That's it. That's it for sections 54EC and 54EE. Only difference between the two of them being 54EC is with respect to an original asset, which is a long-term land or building or both, whereas 54EE can be any long-term capital asset. Now quickly explaining 54H. Let me quickly explain 54H. I'll explain it along with 54D. You can take it down after 54EE, doesn't matter. What 54H says is, this is a compulsory acquisition, right? And we know during compulsory acquisitions, majority of the times, SSEs will not be satisfied with whatever the government is giving them, right? So say SSE has an industrial undertaking which is compulsorily acquired, The compensation or the consideration provided is 3 crores. Alright. SSE says he is not satisfied with the 3 crores. Goes for a lawsuit. Files a lawsuit. Gets an enhanced compulsory acquisition. Gets an enhanced compensation of 2 crores. Alright. But then this enhanced compensation was received by SSE after 2 years. After 2 years. Alright. But what Income Tax Act says is, when you're computing your capital gain, this 3 crore plus 2 crore is your full value of consideration, right? Right, you got a full value consideration of 5 crores. Now, you have to make an investment within 3 years from the date of transfer, right? From the date of transfer, that is X. Now, in case it's a compulsory acquisition, X shall not be date of transfer, rather X shall be the date of receipt of compensation. So say the first compensation, initial compensation, SSE received it on 1 June 2019. So within 3 years from 1 June 2019, the SSE will have to use 2 crores. Sorry. Small mistake. Initial compensation was this. This was received in 1 June 2019. SSE will have to utilize this 3 crores within 3 years from 1/6/2019. That is 1/6/2022. Right. But this was received by SSE on 1/6/2021. As far as this enhanced compensation is concerned, SSE can take 3 years from this date. Use it within 1/6/2024. That's what section 54 says. You will get an extension as to the utilization of the enhanced compensation received starting from the date on which it is actually received. So only take that 3-year utilization clause from the date of receipt. Alright, that's what section 54H tells you. Simple stuff. So whenever compulsory acquisition takes place, always remember 54H tells us the date that should be applicable for deciding the utilization period or deciding the usage of the funds is the date on which you get the compensation in your hands. So that's it for 54EC and 54EE and 54H. Pause, go read. Yes, now let's go to the next section. 54F. Very unique section. Now this is a section where you get a special calculation of deduction and exemption. Deduction and revocation. This is a case where assessee transfers any long-term capital asset other than a residential house property, and out of the proceeds that the assessee gets, out of the capital gain that the assessee gets, decides to purchase a residential house property. So assessee sells any long-term capital asset other than a residential house property, and out of the capital gain that the assessee receives, assessee purchases a residential house property. Why did we mention other than residential house property here? Because if the assessee sells a residential house property and buys a residential house property, it will be section 54, right? But then if the assessee sells any other long-term capital asset, say the assessee sells a long-term capital asset being a plot of land and buys a residential house property out of its proceeds, it will be section 54F that is applicable. Now here, assessee can get a new house property or deposit it, acquiring the same rule as section 54. Purchasing a time frame of 1 year before to 2 years after. Construction time frame of within 3 years after. Alright. Deposit can be made in the central government, capital gain deposit account scheme, and the utilization period is 3 years. If all this is satisfied, and the asset is locked in for a period of 3 years, exemption shall be the minimum of the following. Number 1, based on the investment made. So investment is a new house property plus deposit. Based on that investment, you will get a proportion, not the actual amount. I'll explain that with the help of an example. Say assessee gets a sale consideration of 80 lakhs. Out of that sale consideration, assessee gets a capital gain of 32 lakhs. Invests only 25 lakhs. So the first point says we'll get an exemption based on the investment. So our investment is 25, but then we'll not get the whole amount. Up to all the sections that we learned till here, we found that whatever that we invest, we can take an exemption based on that. But here, only a proportion will be available. So proportion of 25 will be available. So what is that proportion? So 25 lakhs was out of the whole 80 lakhs of sale consideration received, right? So divide with 80, multiply with 32. Alright, that's it. As simple as that. So 25 lakhs is our investment, 80 lakhs is our sale consideration, and 32 lakhs is our capital gain. So what the Income Tax Act says is cross multiply. So 25 into 32 divide by 80. Cross multiply. So find the proportion of this 25 with respect to 32. So 25 into 32 divided by 80 will give you what is the value that will be available as an eligible amount of exemption. Compare that value with your actual capital gain and take the lesser of the two as exemption. Right, fine. Say the assessee gets how much? 32 lakhs as capital gain, right? Assessee gets 32 lakhs as capital gain and assessee deposits it in the central government account scheme. Again, not central government capital gain account scheme, deposit scheme. So assessee deposits 32 lakhs. And out of the 32 lakhs, within 3 years, assessee utilizes 28 lakhs. 4 lakhs remain unutilized. So what did we learn till now? Whatever amount remains as unutilized will be taxable on the date we do not fulfill. We violate our utilization clause. So at the end of 3 years, you haven't utilized this 4 lakhs. And up to sections till 54F, we learned this whole of 4 lakhs will be taxable. But here, that's not the case. Here, this 4 lakh will not be completely taxable. Only a proportion will be taxable. So what Income Tax Act says is take 4 lakhs. This whole 4 lakhs was received for a sale consideration of 80 lakhs, right? So 4 lakhs divided by 80 into 32. Same proportion as this. Here what did you do? We took the investment divided by total sales consideration, net sale consideration. This should be net sale consideration. Okay, not the total, net sale consideration, and multiplied with capital gain. Here we took the total amount unutilized divided by net sale consideration and multiplied with our capital gain. That's it. So do remember section 54F. Only section 54F and 54GB has the applicability of this special computation. So that's why I mentioned special revocation here. Even in exemption, do mention special here, special computation. Even for revocation, the same. Revocation happens when the assessee does not invest in a new asset, either purchase it before 1 year, 2 year time gap, or doesn't finish constructing within 3 years, or doesn't utilize the fund in CGS within 3 years. In case any of that happens, unutilized amount divided by the net sale consideration into capital gain will be your taxable amount as on the date of violating the utilization clause. Now this particular section has a very, very important note. What Income Tax Act says is, see, when you are selling a long-term capital asset other than a residential house property and purchasing a residential house property, then assessee should not own more than one residential house property other than the new residential house property on the date of transfer. I'll explain. Assessee has house property 1. Let's call it as house property A. Assessee has land and sells it. Gets capital gain, buys house property B. Okay, you can take 54F. 54F available. Say assessee has house property A, house property Z as well. Sells land, buys house property B. No 54F. No exemption. Because as on the date of transfer, of the land, assessee already had 2 house properties. Alright. In this case, no exemption under section 54F for purchasing house property B. Or let's change this. Assessee has house property A and has the new house property, that is house property B. Assessee purchased this and sells the land with the intention that whatever capital gain that the assessee gets out of this land sale will be to set off the amount he or she invested for this new house property. So this is the new HP. When does this happen? When does this case happen? We saw when the assessee is purchasing a new house property, he can purchase it 1 year before, right? So sale happens here. So as on the date of sale, if the assessee purchases it before sale, he will have the new house property with him, right? Yeah. In this case, 2 house property in the hands of the assessee, in the hands of the assessee as on the date of transfer is fine. As on the date of transfer of land, if the assessee has 2 house property is fine, provided the second house property is the house property on behalf of which we are claiming exemption. But the case that I mentioned previously, it was house property Z and land was sold for house property B. In that case, no exemption. But in a case where house property B is the new property and that's the second house property he owns, then fine. Then you will get exemption under 54F. Clear? So assessee should not own more than one property. If he owns more than one property, it has to be the new property. That is the property in respect of which exemption is taken on the date of transfer. Assessee should and another very, very important point. Assessee should not acquire another new residential house property based on the specified time period. Say assessee got this and took exemption under 54F. Now in that same year itself, assessee gets another house property D. So what does that mean? The assessee is a pretty rich guy. He's very rich. He has a lot of money. He does not have to have the benefit provided by Income Tax Act to get exemption from paying tax. If he can buy multiple house properties, then he can pay tax. He doesn't have to have exemption. He can purchase many house properties. Then why should we give him this exemption benefit? That's what the Income Tax Act says. So assessee should also not acquire any another new house property based on the specified time period. If he acquires, that exemption is gone. But then if he acquires it after the time period, then Income Tax Act can't do anything. Say assessee purchases this house property D after 4 years. So after 4 years, assessee becomes really financially really strong, and that's when assessee purchases new property. That's fine. It doesn't matter. All right. But then if the SC purchases the house property after just 1 year, that falls under the time frame of 1 year before X, 2 year after, right? It falls under this time frame. In that case, whatever exemption that you took will be cancelled, will be revoked. Alright. That's it. Whatever amount you claimed as exemption flags will be treated as taxable amount in the year of violation. Next, going to 54G. 54G and 54GA are very similar sections. Very similar sections. It is with respect to transferring a capital asset which forms part of an industrial undertaking from one area to another. Alright. So SSE transfers an industrial undertaking, shifts an industrial undertaking from a rural area to an urban area. So from a village to a city, from a village to an urban area, as he wants to shift. So in that case, any capital gain that the SSE gets shall be treated as exempted, provided the capital gain is used to purchase certain kinds of assets. What are the certain kinds of assets? It can be plant and machinery, land and building, or any other equipment or apparatus that the SSE requires for that industry. Because say SSE had an industrial undertaking in place A, and this was a rural area, this was rural, and this is urban. Right. Now this is sold, this is transferred. So in this transferring process, plant, machinery, land or building, any rights that they had were all given up by the SC. And for that the SC received compensation. The SC received consideration. That consideration was used to purchase the same things at B. Or that consideration was used to build a new industry at B. Or that consideration was actually used to shift whatever that the SSE had at A to B. They are shifting whatever they had from A to B. There are scenarios when people move factories from one place to another, right? Haven't you heard? So they can use the money for that purpose as well. Or at times the SSEs will have to incur certain expenses as specified by the government for this purpose. For the purpose of shifting, government says if you want to do that, you will have to pay certain fees as well. So SSE use this consideration SSE receives to pay this legal fees. So if it's such payment that SSE makes, then whatever payment that you make, man, you can take it as an exemption, provided it falls a time frame within a time frame like this. So X date of transfer, X is the date of transfer. Behind we can go 1 year. After we can go 3 years. In 54 it was behind 1 year, after 2 years. Here we can go behind 1 year, after 3 years. So before 1 year, after 3 years. That time frame. In this time frame we need to get the new industrial undertaking set up and running. Alright. Or deposits in the capital gain account scheme, but then utilized within 3 years. If not utilized, what will happen? Revocation, complete revocation. Also, do note, the asset acquired at B or whatever the investment that we make at B should have a lock-in period of 3 years. That is, this industrial undertaking that we set up at place B should be there with the SC for 3 years. If you sell it off at the end of second year, then at the end of second year, as on the date of selling it off, as on the date of transferring it, whatever exemption that you took previously will be treated as income. So if all those conditions are satisfied, minimum of the following shall be provided as an exemption. So amount invested. Amount invested means whatever asset that we purchase and whatever deposit that we make, compare with capital gain, take the least. That's it. 54GA is the same. The only difference is transfer of capital asset in case of shifting industrial undertaking from urban areas to SEZ. Here it was transferring to a rural area. From urban area, we are transferring to rural area. Oh my goodness, I made a small mistake. This wasn't rural area. Sorry. This was urban area to rural area. We are going from urban to rural. That's the process. Industrial undertaking in an urban area, and we are going to rural area. Sorry for the mistake that I made. 54GA is when we are going from urban to a SEZ. We are going to a SEZ. Alright. Rest of the things as same as 54G. Nothing much. Same. Now the final section, 54GB. Remember when I taught you the structure, I told you the investment that the SC can make is 1 with a new replacement asset, 2 with certain specified assets, and 3 with a specified company. Yeah, that's what we are discussing here. Section 54GB tells about the deductions or exemptions from capital gain on transfer of a residential property for investment in an eligible company. So ACCA transfers a long-term residential house property or a long-term plot of land in this particular period. So in this particular period, starting from 1/4/2012, that is from financial year 2012, ending at financial year 2021, ACCA sells a long-term RHP, a long-term RHP or long-term land. Alright, whatever proceeds the ACCA gets, invests in a eligible specified company. Alright, so this investment can be by way of purchasing assets for these companies or can be by way of buying shares of this company. Alright, so purchasing assets can be buying assets or buying shares. So that's the eligible investment. Now this investment should happen within 1 year after the date of transfer. Alright, 1 year after date of transfer. In such a case, provided you've satisfied the lock-in period as mentioned here, that is, if you are purchasing assets for the company, it's generally 5 years. The assets should stay with the company for 5 years. For any IT related assets, that's for things like computer and peripherals, the lock-in period is just 3 years, because computers get obsolete very fast. For computers, the maximum lock-in period that the Income Tax Act asks for is 3 years. After 3 years, you can sell off those computers. But for other assets, these assets have to stay in that company with the balance sheet of that company for at least 5 years. In case of shares, these assets have to stay with you for at least 5 years. So generally, lock-in period is 5 years. But if the assets are computers, then it has to stay for only 3 years. Or the assessee decides to deposit it in a central government in a capital gain account scheme, it has to be utilized within 3 years. Alright, if that's the case, if the assessee purchases an asset or makes a deposit as mentioned here, then no problem, you can take exemption. But an exemption, as I had previously told, for 54F and 54GB is very particular. Only a proportionate amount will be provided. So here what the Income Tax Act says is, whatever investment that you make, divided with net sale consideration, multiply with the actual capital gain received. Same thing as we saw in 54F. For revocation, it's the same thing as well. Unutilized into capital gain divided by the net sale consideration. Clear? That's all for 54GB. So yes, pretty long class, right? Yeah, it was very long. It was actually very tiresome. But then I'm hoping you guys actually understood the whole concept of all the sections ranging from 54 to 54H. Yeah? Understood everything, right? So yeah, with that said, I'm closing this video. If at all you have any doubts, please feel free to reach out. I'm always here to provide any sort of assistance that you would require. Reach out anytime you have a doubt. Yeah, you can use the message box, you can use the chat window, whatever that you want to. Reach out. I'll be there to provide any sort of assistance that you would require. And with that said, I'm closing this session. See you in my next video. Till then, take care, stay safe and study well. Bye-bye.